is the Economic Review this morning. My name is Simba Elijah Charles Kiage. We are joined by Washington Daguerre, and Edward Kusamo is going to be with us shortly as we try to get to him. Mr. Daguerre, good morning, sir.
Good morning, Simba.
Everything is fine. Let's get into it this morning, where tax collections in the just ended financial year grew at a slowest pace in recent history on the back of depressed business profitability and job losses in the second half, which started even before COVID-19 struck. Official revenue statistics Friday showed that tax receipts in the financial year ended June 2020 rose a measly 0.92% to 1.453 trillion compared to 1.44 trillion a year earlier. Now, the nearly 13.26 billion growth in tax receipts that the Kenya Revenue Authority collected is the most sluggish in recent years. Now, the tax receipts missed the fresh target of 1.47 trillion set by Yatani a couple of weeks to the end of the fiscal year 2019-2020 by, now wait for it, 12.74 billion. Now, the Treasury chiefs revised full year tax goal 3 times in the just ended fiscal year from the original target of nearly 1.81 trillion to 1.7 trillion in November 2019. Now, the 1.49 trillion in April and 1.47 trillion late last month compared to original estimates. The taxman missed the target by 19.59% or 354.18 trillion. Good. So the question being, what tax environment does Kenya find itself in as a result of the COVID-19 pandemic? And if you look at VAT, it is among the major contributors to KRA's collections in this financial year. How has it been affected by the COVID-19 pandemic, and what are the chances of KRA substituting the effects with the new tax measures introduced in the finance bill? Good. All right, now, Washington, let's just go back and look at that. Remember, we are talking about the missing the last target by a whole 12.74 billion, and that was just before the onset of the COVID-19 pandemic. And now you could actually see that in last fiscal year they did revise their targets again thrice. All right, and during that time we could actually see a lot of supplementary budgets that were thrown for us in the economy. Talk to me. If VAT and VAT is among the biggest contributors of Yatani's document, what position does he find himself in right now?
Simba, there's one thing you need to understand, that the biggest problem we have in this country is actually tax collection. And this is not the first time that tax collection in this country is being missed, but this has become even worse because of the COVID-19 pandemic. The fact that the economy is not as vibrant as it was supposed to be. The restriction of movement by people, that means there's even lessened economic activity in the country. That means the tax collection was bound to be missed by the government. That is not rocket science to see that. But the biggest problem now is this, is that the now, in a bid to meet its target, it has gone now for wider tax brackets, so to speak, to include more activities, to include goods and services that are not previously been taxed into the tax bracket. What are you talking about? For example, like in VAT, so many services and goods have been included in VAT. I remember there was an uproar, actually the government including VAT taxation on, for example, farm inputs. That one raised an uproar in Parliament because they said the moment you include VAT taxation on farm inputs, you are going to increase the cost of production of food production in this country. That's not something that you do. And remember, this was in the tax amendment bill of 2020. That is when, and it was supposed actually to ease the suffering of the people. But you find that the proposed measures was actually to achieve the exact opposite. Come even to something like the insurance industry. You find that in the insurance industry, you are previously tax exempt. The insurance agents and brokers, the intermediaries of this country. Now, as we speak right now, they have included, they have started taxing our services, our insurance services. Remember, like we kept on, like I've been saying all along, we do we pay withholding tax, we pay income tax, and now our services are being VAT taxed. VAT has been introduced on our services, making us believe, I think we are the most taxed group of people in this country. But that's not the point, because, well, the case has gone to court and has been suspended, so to speak, because, but the point is this: the government is trying to do everything to include previously exempt services, VAT exempt services, into the tax bracket in a bid to increase taxation. But the point is,
Which brings me to my next question now for Washington this morning. So if you look at exactly where we are, I mean, we have to go back and see the deficit that we did hit, 12.74 billion in the last financial year. So if you look at whatever it is that they're doing, now I know now you're getting taxed. I know there's a lot of areas that are getting taxed now that we didn't expect to get taxed. I know that we now have the 1.5 digital tax that has been operationalized. Do you think that is enough to counter the effects of the COVID-19 pandemic, owing to the fact that we do expect that also their biggest tax point, VAT, is going to be really hit as well this year?
I didn't get that. You've been disconnected for most of the time. I couldn't. You've been disconnected.
All right. Can you get me now, Washington?
I can.
Fantastic. So the question is this. Now, if you look at the way in which the government has approached the way the tax environment now is a bit depressed. They've introduced new tax measures. We do know now that the areas that were getting taxed, that weren't taxed previously, they're now getting taxed. We don't have key areas like the 1.5 digital percent, the 1.5% digital tax that is now being operationalized. Do you think that is enough, therefore, to counter the effects of the COVID-19 pandemic?
Of course, that is not enough. That is not enough, because I think, you see, the biggest problem we have in this country is this: the economy has shrunk. That's a given. Now, whatever is the little being achieved in this economy is what the government is going for. But that is not the way to go about it, because I believe the country, this government should be looking at ways of increasing, expanding the economy to grow, so that they can be able to tax the people. You cannot continue shooting yourself in the foot and expect money to be coming in. You cannot be sabotaging the same economy that you're going for. It's like denying to give a cow napier grass or whatever, and then you still want to milk it in the evening. This cow is gonna die at the end of the day, or the milk production that's gonna be done is not be what you expect. The point is the government should be increasing the economy of this country by the various ways to do economy expansion, by giving tax rebates, by doing there's so many things the government should be doing, not taxing. Taxing is not the way to go for this government. And what about the corruption that we talk about every day in this country? Look at, the GDP. We talk about a third of the GDP money going to people's pockets. What kind of economy is this are we talking about?
All right, Washington, I beg that we move on to the next subject this morning. Now, sugar directory data shows that the three farms, all right, owned by Y family controlled 45% of the total sales of the sugar in the country, at nearly half of the sales in the last 6 months. Now, this has grown from the 41% market share they held in corresponding period last year. West Kenya had the lion's share at 29%, followed by Sukari Industries at 11%, with Olepito coming in at a distant third, with 2% of the total 292,040 sales reported between January and June. West Kenya has for long held position 1 in both production and sugar sales, controlling nearly a third of the market share. On the other hand, the state-owned mills performed dismally, with a number of them remaining closed during the review period. Now, the state is planning to lease out all its factories to strategic investors, as it seems to give them a new lease of life through fresh capital injection to improve productivity and cut on imports. Now, this revelation, therefore, comes at a time when the Sugar Task Force report implementation process has already wiped off all the debt for state-owned sugar millers in the economy, and all trade licenses for the commodity cancelled in Kenya indefinitely. Question being, therefore, what does the private sector dominance of the industry mean for the government's chances at reviving the industry? Interesting when we look at this data this morning, Washington. You did look at those proposals from the Sugar Task Force report. They were saying, well, we have to forgive all the debt for sugar-owned millers in the country, that is state-owned. But if you look at the Rice family that owns more than a 45% of the sugar stake in this country, what does it mean now for the state's chances at reviving the state sector? I'm talking about the sugar one.
Simba, let me tell you, there's something called the sugar politics in this country. And the biggest problem with sugar is that it has never gotten a grip of production, or it has never really gotten a grip in this country how to do sugar. I don't think this country is made for sugar production in the first place. If you look at the history of sugar in this country, you find that from the beginning, why even Western Kenya, for example, was made into a sugar belt, was basically to allocate the various regions according to the best cash crop that can do in various regions. So Western region was chosen to do sugar and cotton. But you find, even by the mid-70s, there was already an issue of sugar production and economic sugar production in a way that it can survive, or it can be enough for this country. Because the thing was moving away from sugar imports, so to speak, and the country producing enough for itself. But you find, after some time, the politics of sugar is that sugar production is land intensive and capital intensive. That means for you to do sugar in economic quantities, you've got to number one, spend a lot of money. Number two, you've got to have a lot of land so that to reduce the amount of money that you spend per ton of sugar. In Kenya, that's exactly the opposite. You never have enough land. Most of the sugar being produced in this country is 60% is being done by small scale groups. That means they don't produce sugar in by economic quantities. The amount of money being put into per ton of sugar is actually so much more than what other COMESA countries produce, and that's why you find sugar from outside of this country is far much cheaper by over 70% cheaper than what would happen. So it would make sugar more sensible to import than for us to grow.
Washington, I just want to bring in Edward Kisebwa this morning so that now we pretty much get our sentiments together on the subject. Edward, I think you saw what the CS did the other day. Well, cancelled all the trade licenses for sugar in the country indefinitely. We haven't got another communication of exactly what it's trying to achieve or when you can actually get to trade in that. Do you think that is cognizant of the fact that it is the cartels in the country that are eating into the government's stake? Or what do you make of that move from the ministry?
Okay, thank you very much for inviting me to speak on this subject. And I think what my colleague has said, Washington Ndege, is that indeed there's this politics of sugar in this industry. And I think part of the reason why this happened is because I think of the cartel system that has been there, the brokerage system that has been in the sugar industry, where the farmers are not able to reap the profits that they're getting from their production. And I think that's where the problem really begins. And I think we need, transparency and accountability in that sector. And we need the Ministry of Agriculture to come out clear and start supporting farmers so that this sugar industry could be as productive as it should be. Otherwise, the figures that Washington is giving, I think they make a lot of sense from where I sit. And the sugar belt, talking about the sugar belt and the politics of the sugar belt, I think we need to start looking at our cost of production in this part of the world, whether we are competitive enough. I mean, if it all goes to the cost of fuel and the cost of production and the cost of inputs. If we are not able to compete with countries that already have low cost of production, then it becomes truly unreliable for us to move forward with producing sugar. And maybe, as Washington has said, we may start thinking about importation as an alternative to production locally. And I think that is something that we really need to start thinking about moving forward.
Interesting, therefore, that we are talking about importation, but looks like that's something that the government actually wants to move away from. Now, Washington, just as we clear our thoughts on this subject, I want to bring you back again on that issue. Look, It is more than 45%. And with the way things are going, therefore, it might be worse. Because look, I mean, if majority of what we're bringing in is through importation and the private sector has 45% of that, then you can actually say that the government pretty much has nothing. Because what we do know is that the top millers for the state have been pretty much dead for quite some time now. So, I mean, what are we trying to achieve? Because at the end of the day, then, if you're actually saying, wow, cancel the licenses and promote the local sector, then actually whatever you're trying to say is that this commodity is going to be very, very much expensive. And to the point now that the private sector has quite a bigger stake than you do. I mean, if you go ordinarily what the numbers are saying, then I mean, what are we trying to fight? Do we let it go and say, well, the only thing that we need to do is let the private sector control it as they have been throughout this time?
I think just like Edward has said, the biggest issue we have in this country is this. Why should why should we be developing a sugar industry in this country in the first place? Number two, let people import, let people be, I mean, when you're given a license to do, for example, importation, there's always parameters that you're given at, that this is the price you're going to import at, or this is the way you're going to distribute, and all that stuff. But getting into sugar, we should not be encouraging Akina Mumias to get back to production. We should not be encouraging Akina Chemiri and Sony Sugar. They should be shut down and those assets done away with, you know. KCB made a risk by loaning Umia so much money. That's a problem. They can't be able to get the money back, you know, because at the end of the day, if they have done the homework properly, they shouldn't even have gotten into Umias in the first place, you know, because sugar production in this country is now supposed to have happened. If you did, you see, I've just told you, in the 70s, already issues of production in this country. In the 70s, they had already identified that sugar cannot do, you know. It would have made more sense to do away with sugar and plant maize, groundnuts in Western, because they produce more. There's more economic activity from sugar than what is happening. So, why is the government talking about granting licenses for importation of sugar? Let them grant licenses, private licenses, definitely. Because the moment you give it to the government, what's going to happen? You know the agricultural sector. The other day, the CS of agriculture was sacked. There's so much corruption going on in agriculture. And remember, there's nothing as important as agriculture in this country, because it's about feeding the people.
There so that we have time to move into the next issue this morning. Now, this one interests you, and I'm going to start with Kusawa this morning, where monthly interest rates charged by the digital mobile lenders and borrowers' non-performing loans will be regulated by the Central Bank of Kenya if Parliament adopts a law that is currently before the House. Now, the Central Bank of Kenya Amendment Bill 2020 will empower the regulator to keep digital lenders in check to curb the emerging number of borrowing rates that has left many in the country in debt. Now, the digital lenders have previously been accused of charging high interest rates, predatory lending tax, as well as using illegal methods to recover loans, including debt shaming, among others. Now, the promise of digital credit is to make people with no documented financial history visible to the formal financial system, helping low-income people gain access to loans and other financial products. Now, the new law, Kusawa, will ensure that the digital lenders adopt the same rules as commercial banks in the country. Question being therefore to you this morning, is this a threat to financial inclusion in the country, and what would be the benefit of bringing mobile loan providers under the same regulatory framework as the banks?
I think, you know, sometimes some of these policies are misplaced. I mean, if you look at the cash reserves of these mobile lenders vis-a-vis what the commercial banks have, really, it's not in the same level. But again, the risk, the business risks and the financial risks that arise from these mobile lenders and the risks that most of these lenders have is quite high. And indeed, it's good for them to be regulated. A lot of people who go for these loans are looking for working capital requirements and cash reserves for their small businesses, which is easily available and which obviously banks are not able to dispense at the rate at which these mobile lenders are able to give. And therefore, I feel that, you know, they are part of the financial system, or they are part of the financial ecosystem. And so definitely, you know, regulation will be something to bring, you know, sanity into this part of the sector. But at the same time, the risks are high. KYC processes are very low. And so, there's all these, financial and business risks that these commercial entities are going to have. So it's just a way to approach on the success, whether the regulation is going to cap or increase the interest rates that, that are already high from the mobile sector.
Dick Washington, I want to bring you in on this as well. I mean, we're talking about bringing the mobile digital lenders in this country under the same framework as the banking sector. That whatever it is that we push in the banking sector has to be, therefore, observed all the way down to everybody who's lending money to the economy. How does it make you feel? And do you think that we are losing that financial inclusion that we're talking about if you heavily regulate these digital lenders?
You got to remember, Simba, these digital lenders are basically Shylocks. There's no difference between what these guys are doing. Or all these guys at the corner in towns, all they do, Shylocking and that stuff, with exorbitant interest rates. Guys doing interest rate at 30% per month. That's something over 300% per year. So for being regulated makes a lot of sense. They should be regulated properly. And just like Edward has said, these guys don't do any KYC. Customers, it's amazing. If you default on these guys' money, what they do is that they embarrass you to pay. They get in touch with your contacts on the phone. So these guys are awkward, but these people should be completely regulated. I mean, it is good. The kind of money that they give is good because it can help your business grow. It can, if you use the money wisely, it's good. But we all know how the economic space is right now, how the economy is doing. You invest and it goes away, especially during these COVID-19 times. But for these guys together, they start calling Simba and telling them Washington has defaulted on his loan. Go around, how do they want me to embarrass me to pay back? I can't pay if I don't have the money.
Yeah, I just wanted to jump into the last one in just 2 minutes now. Now, the Cooperative Bank of Kenya bid to acquire controlling 90% stake in Jamii Bora Bank is now laying bare rifts among the existing shareholders of the small capital staffed bank. Information in a local daily indicate that for institutional investors in Jamii Bora that own a stake of about 45% are not private to the lender's financial health or the details of the proposed transaction. Now, the transaction in which Coop Bank will pay 1 billion for new shares is progressing without a definitive agreement on their terms. Now, the new agreement means that existing shareholders will not take out any cash in the deal. Now, with Bolt Bank earlier this month, the Jamii Bora Bank shareholders had endorsed Cooperative Bank of Kenya's offer to buy majority stake in the small lender, which paved way for the conclusion of the deal in which Coop was to be issued with 224.1 million new Class A shares, while the stake of existing shares be deleted to 10%. Now, question being, and I want to bring in Kusawa Days as we clear with Washington. Now, what position do smaller banks in the economy find themselves in the wake of massive loan restructuring occasioned by the COVID-19 pandemic? And generally, what position will this acquisition put Coop in the top banking institutions in the economy? All right, now, Kusawa, I just want to bring you in on that now. How do you rate the smaller banks' position in the COVID-19 pandemic era?
I think the COVID-19, most analysts are speaking, is quite unprecedented, whether it's a small bank or whether it's a big bank. And, all small banks are finding it hard to keep up with those requirements because of, obviously, of the way the market is behaving at the moment. When there's very low business activity, as is being seen right now, there's a struggle for most financial institutions to be able to, continue with their mandate. And so requirements, new strategies these banks need to come up with, not just the small banks, but there's also the big commercial banks that have been in existence to be able to see their strategies as far as markets are concerned and as far as clients are concerned. I think a lot of businesses, if you look at the different sectors that look at products, that get products from the banking industry, agriculture or manufacturing, they really need to start restructuring their model to be able to fit into this new normal that we are seeing. And so we need something that is different. We need some new kind of thinking that is not there before. to be able to help businesses in their working capital requirements, their cash flow requirements. If you look at commodity prices, they have increased over a period of time, and this needs a revision. If you look at cash reserves, if you look at currency devaluation has happened over the last few months, 3 or 4 months, and therefore a new strategy is needed for banks to be able to get moving forward with progressive strategies.
Thank you very much, Kusawa, for joining us this morning. Now, Washington, in just 15 seconds, therefore, as we cleared this morning, what are the chances of the banking sector now? And I'm talking about the smaller banks in the economy. How do you rate their chances under the COVID-19 pandemic?
Well, we know that the bigger banks have a higher chance of succeeding or being successful in the economy than the smaller banks, because just like Edward is saying, banking is all about the deposits that are made in the accounts, so to speak. The banks is being called small because it doesn't have enough deposits. It doesn't have enough deposits actually to do business with, because we know how banks make money. They make money by lending the same money that you deposit in their accounts. So if they don't have enough money to lend, then how are they going to survive? And like we said, with these COVID-19 times, the economy has shrunk. Actually, and then, there's also this issue of the mobile phones, saving through the mobile phones, for example, in M-Pesa or Airtel Money. So many people are finding it easier to save in the phones than going to the bank to do. Actually, let me say, most people only deal with banks, for example, through payment, if you're being paid a salary through the banks. Or if you're paid through checks through the bank. If you're not get paid through the bank in your salaries, or your business is not getting checks, you're being paid through M-Pesa, what's going to happen to these small banks? Of course, they're going to be swallowed by the big ones. So we are moving towards mega banks, so to speak. And these small ones will have a very, very hard time surviving in the economy.
Washington, unfortunately, man, we don't have more time to delve into these points, but your points have been well clear this morning. We appreciate you joining us this morning, Washington. Always a pleasure to talk to you, Edward Kusawa, as well. Thank you very much for making our economic review a success this morning.
Thanks and good day.
All right, that's exactly what we have for you this morning. We take a short break. Once we come back, let's look into tax issues in the country.